Forward. All right. Well, good morning, everybody, and thank you for joining us for today's agent development training. Um, I'm excited to host today. We actually, I think 2 weeks ago, kind of touched on this a little bit, and I literally think in that call that we were doing, I said, "Hey, we just need a whole hour on this particular product and topic and subject." And so we have finished the 12 modules that we had scheduled with last week's conversation about compensation and reports. So we'll be getting those posted to the Resource Center, and you guys can go back and watch any of them that you've missed in recent weeks. I think those are many of those are worth recapping. I'd continue to encourage you to utilize the YouTube channel because we are posting these and some other trainings that are out there, and so you can continue to immerse yourself in the business and continue to learn from past trainings that we put out there. I try to keep those trainings on YouTube um, to the last 18 months because things do change so fast in our business. I just don't want older archaic information out there. So that's our goal anyway. But today we're going to spend the majority of our time talking about a couple of topics, but specifically long-term care insurance, and probably even more specifically, some of the products that we have in our portfolio that we refer to as hybrid products. They're combinations of long-term care insurance and life insurance smashed together. And I think that, as we continue to evolve, especially in the Medicare space or working with clients that are approaching age 65, long-term care insurance needs to be a conversation that we're having with the clients that we serve. I think most financial advisors would say that it's best to purchase these products, somewhere between 50 and 65 years old. People start getting into their mid to late 60s, into their 70s. The products become much more expensive, and they're also underwritten in almost all scenarios, which means they got to be pretty healthy, to get any form of long-term care insurance. And so I know personally when I'm talking to clients about their Medicare, I also want to set the stage that we're going to have an additional conversation around other products like long-term care insurance. I think, when you think about those Medicare clients, we're helping them with their base Medicare. We're helping them with any supplemental insurance. We're potentially talking about final expense life insurance products for them. And I do think the long-term care discussion needs to happen. And so I typically open that conversation with my clients by just asking, do you folks have any form of long-term care insurance in place? Or have you thought about this or had conversations about it or, even looked at it at this point in your life? Um, I will tell you, most people say we haven't or we don't, or maybe we looked at it and it was very expensive. Very few people actually take action to purchase any form of long-term care insurance. I think when you look at some of the statistics, though, I read an article here recently that said if you live to age 65, there's close to a 70% chance you're going to have a long-term care need before you pass away. And I think this problem is getting bigger and bigger, especially for the clients that we're serving, for a number of reasons. First of all, people are living longer, right? So the cost of care at the end of their life, they need to figure out how am I going to be paying for that. Number two, I go back to this reality of the fact that there's 10,000 people a day turning 65 right now, and over the next 6 years, it's going to double to 20,000 a day, and then it's going to plateau for a decade after that. I'm telling my clients today who are turning 65 that you're in a uniquely different position than anyone before you has ever been. And part of the problem is the massive demand that is going to be in place if and when you need some form of long-term care, benefits to be delivered to you. Today there's a lot of people obviously needing long-term care, but you think about 20, 25, 30 years from now, what that looks like, it's going to be a much, much larger group of individuals seeking care. Um, I think it's important to understand what we're talking about when we speak about long-term care insurance. And I tell my clients it's kind of three buckets of potential risk. It's nursing home, assisted living, and in-home health care, or one of the three. But it kind of encompasses all three of those types of buckets when you think about, long-term care. And the way it works today in most states is that if you get to a point in life where you need help and you need assisted living, you need to be in a nursing home, or you need somebody in to come in and take care of you. First of all, I think it's important to understand that Medicare was never priced or designed to cover this well. Medicare is designed to cover medical expenses, not necessarily the need for long-term care. There is a very small amount of, skilled nursing coverage available within Medicare, whether you're on the traditional Medicare path with a Medicare supplement or you're on a Medicare Advantage plan. Both of those paths do have some benefits available, but it's a very limited amount. How it works under Medicare is that someone has access to skilled nursing for up to 100 days following um, a couple of days in the hospital. And they have to be in the hospital. I think it's at least 3 days in the hospital, 2 nights, like two midnights in the hospital, 3 days. And if that happens, then Medicare will cover up to 100 days in a skilled nursing facility as long as you're making progress and getting better. And that's one of the issues that you will deal with if you're in the Medicare space long enough, is that you'll get somebody who, is in the hospital for a period of time and then they move into a nursing home, a skilled nursing facility, and they're not getting better. They're not doing rehab, whether it's them or they're, just where they're at. They're just kind of flatlining in that facility. Many times, Medicare or the Medicare Advantage carrier, after a couple of days of that, will say, okay, we're done now. And this throws families into a complete tailspin. I've had many situations where the families come to me and say they're kicking mom and dad out, or the insurance is refusing to pay for it. Um, those might be true statements on one hand from their perspective, but the reality of it is that oftentimes that family may not have adequately planned for what's going to happen when mom needs care or help or assistance. And oftentimes they're in a situation where, they're scrambling to figure out how are we going to pay the seven, eight, $9,000 bill to keep mom in here? Or are we moving mom home with one of us? Or is somebody moving into mom's house? Are we paying for caregivers? Like, what's the plan? Some of you have experienced that process in your lives, and it's not fun to navigate through. One of the things that I think is the reason that people find themselves in that situation, though, is because nobody adequately planned for those long-term care needs. And so I think it's part of our job and our role to tell our clients about what their risk is and to begin to have those conversations in their 50s or early 60s with them. What I tell my clients, and this is a line you can steal if you'd like, but I tell them, I don't think everyone needs to buy long-term care insurance, but I don't know enough about your situation to say whether you need it or you don't. I don't push my clients to buy it. What I do push my clients to do is think about it, talk about it, have a conversation about it, and potentially even make a decision on what you're going to do while you're still healthy and you have a choice to make. This is one of those products where once you get deep enough into life and health concerns and issues, you may or may not even be able to qualify for it. And I will tell you, I've had a lot of these conversations over the years with clients who come in and tell me we need to get long-term care insurance. And instantly, where my mind goes, if you need to, you probably can't get it, right? I had somebody call me yesterday, a longtime client. His son, who I've known for many years, called me and said, hey, we've got a situation with dad. He's living by himself. We thought he had cancer. Ended up doing a bunch of tests and everything and realized that he actually has Alzheimer's. And all the markers are there. And we thought it was cancer because he was forgetting to eat. And so he's lost all this weight. I mean, like he was not a big man to begin with, but he's down to skin and bones and they couldn't figure out what was going on. Well, his Alzheimer's was, he was forgetting to eat. And so he called me, he said, we need to buy long-term care insurance for dad. And I'm like, it's too late. Ed, I'm sorry. Like once you've got a diagnosis of Alzheimer's, there's no insurance company that's going to, sell you a good long-term care insurance policy. So this is, I think, where we've got to push on our clients. We've got to say, hey, let's talk about this. Let's have a conversation about it. Let's think about what your plan is while you still have a choice to make and how you're going to protect yourself, because eventually that choice will go away and the choice will no longer be yours, regardless of how much money you want to pay. You can't buy it. So that's kind of the thing that I think we need to push clients on a little bit. So when we think about long-term care expenses, around here in Northern Indiana, they say the average nursing home cost is $7,000 to $9,000 per month for someone to be in there. You start thinking about other alternatives to that. There are things like in-home health care and people that can come in and help a little bit. And oftentimes that's where people start off. The way it works in most states, though, is that if you need that type of care, and it's not covered under that 100-day window that we talked about related to Medicare. If it's just someone aging and needs help, typically that person is responsible for paying the cost of that expense. Um, And many situations they need to burn down their assets, so pay using their assets and deplete their assets down to a point it's around $2,500 in total assets. And at that point, then many people have the ability to move into the state low income Medicaid program. Medicaid is the state, most states have a Medicaid program. And right now, there's a lot of people who are in long-term care facilities or nursing care or things like that are leveraging and using Medicaid. So that's where a lot of people are going to land. I will tell you this is a big problem, and the states are realizing it. 17 states actually have legislation in process right now. 17 states actually have legislation in process trying to figure out how to handle this. Because the reality of it is if consumers and our families don't buy long-term care insurance and then they need it later in life, they're going to burn through their assets and then ultimately it lands on the state. And the state is looking at this aging population, the baby boomers coming in. The states are saying, how in the heck are we going to actually pay for this? There's only one state that I'm aware of that has actually passed legislation. I think it was the state of Washington, and they did it poorly, in my opinion. When they did this, they actually said, we're going to give you, I think it was 90 days to buy long-term care insurance, or we're going to start charging you a tax penalty for not having it to help fund your future care that you might need. If you're going to rely on us, we're going to start taxing you for it. So I don't think that was a great solution, but other states are looking at this, and it is a very, very real problem. So that's kind of the backdrop, for the risk that we're looking at. When we look at the products that are in our portfolio, and I think products that are available to a consumer, I kind of place these products into three different types of buckets. First of all, there is more of a short-term care type of solution. I would look at the Aetna Recovery Care. We're not doing training on that today. Maybe we should, but the Aetna Recovery Care product is more of a short-term product. It typically gives them some help and some relief for up to 12 months. You can build it in different ways at different price points, but it's more of an entry-level type of long-term care. 12 months is usually the maximum benefit that you would get on that. Then you move into two other types of long-term care. There would be a bucket that I would refer to as traditional long-term care insurance. And then there would be a third bucket, which would be hybrid long-term care insurance, which is a combination of long-term care insurance and life insurance smashed together. So I want to talk quickly about the traditional model. We do have a vendor that we work with who can help us quote with Mutual of Omaha traditional long-term care insurance. There's very few carriers that actually sell or promote traditional long-term care insurance today. The two big dogs in the industry were Genworth and John Hancock, but 5, 6 years ago, they decided to pull out because it was very difficult for them as insurance companies to predict what the future cost of care would be for someone. And they did a very poor job of appropriately pricing those products, which caused them to have to raise the rates. And they finally got to a point where they said, we don't even want to offer this product anymore because it's too hard to figure out what we need to charge today to deliver an appropriate benefit in 25 or 30 years to a consumer. So we have seen a lot of insurance companies pull out. Mutual of Omaha continues to be a viable option. We do have a vendor, like I said, that we work with. Liz Quinn is the gal there, and they can help if you need quotes on more traditional long-term care insurance. I would say there are two problems that I have with traditional long-term care insurance. This is worth writing down because this is what I tell my clients. Two problems I have with traditional long-term care insurance. First of all, that rate starts out at whatever rate it is, but those insurance companies can raise that premium whenever they need to get back to where they can be profitable. It's subject to state regulations and state oversight, but I have seen long-term care insurance policies where when people got into their 70s or 80s, they had 20, 30, even 40% rate increases, and they got priced out of it later in life before they could ever begin to use the benefit. Um, and so that's one thing that I think is a real negative when it comes to traditional long-term care insurance is that you could potentially get priced out of it because there's no rate guarantees, no rate locks, nothing like that. The second problem that I have with traditional long-term care insurance is what if you don't have an extended end of life situation? What if you're hit by a bus or you pass away of a heart attack in your late 80s? All that money that you would have paid into a traditional long-term care insurance policy would just be gone into thin air if you pass away without an extended end of life type of situation. So those are my two concerns with traditional. Number one, they can price you out of it. Number two, if you don't use it, you lose it. So that's worth understanding. So what we saw over the last decade or so is that as people left, or as insurance companies left the long-term care market, some of the oldest and most financially sound companies in the world, life insurance companies, came into this space and began to build some products. And so this is going to be the focus of the rest of our conversation today, is around a product that I refer to as a hybrid product. It's a combination of long-term care and life insurance smashed together. This particular product is, I think, unique and different because it solves some of the problems associated with traditional long-term care insurance. Number one, because we're building this policy on a life insurance chassis, we can lock that consumer's rate or premium in for the rest of their life, guaranteed. Can't do that on traditional long-term care insurance. On a hybrid, you can lock them in for the rest of their life. The other big benefit of this product is because it's a combination of life insurance and long-term care insurance, the benefit is going to get used and paid out in one way or another. The way these products actually work is that you have a life insurance policy. And just for very easy, simple math, let's say you had a $100,000 policy. So this $100,000 policy, if you trigger the policy or it's triggered by a need for long-term care, you can start tapping into the policy and it starts paying you out 4% of the death benefit per month that you can then use to pay for expenses related to long-term care. So a $100,000 policy could pay up to $4,000 a month to the beneficiary until that $100,000 bucket is depleted. Um, so the big benefit, I think, of this policy is that you're guaranteed to get something out of it as long as the premiums are paid. You're either going to burn it up, paying for long-term care expenses while you're alive, or it's going to pay out as a tax-free death benefit to your heirs through the life insurance policy portion of the program. So to me, this is the one product in our portfolio where it's guaranteed that a client will get it. I guess permanent life insurance would be the other one, but that one way or another, they're going to get something out of this. And I tell my clients, I put most insurance products that I sell into the expense category for a consumer. What that means is they're paying a premium and they may never even use the insurance, right? This is a product that's uniquely different. I put it more in the reallocation of asset column because what they're doing is they're taking an existing asset and reallocating it in a way that they're guaranteed to get something more out of it. So it's pretty cool how it works. Now, where we're going to focus today is we're going to focus on the Securian or Minnesota Life products, and they have two products that are in this hybrid category. One is called their Protector, and we'll show you that in just a moment. The other is their Secure Care. So it's two different products that are probably built a little differently for specific reasons. I'm going to start off by talking through the more simple version of it. And then Steve is going to jump in and finish up with talking a little bit more about the Secure Care. One thing that I do want to show you, though, before we jump into that is I had put together a few talking points that I have used. A lot of times these conversations don't happen in like it's an immediate sale usually. Usually it's a kind of a conversation that happens over a little bit of time before the consumer decides to pull the trigger and make a purchase. So this is an email that I have used fairly regularly with clients, and this was a client that I had a conversation about, and I said, let me send you some highlights. So I'm just going to read this to you because it kind of summarizes what I talked about a little bit. Sandra, I'm sorry, I can't zoom in because this is a email. I knew you were going to ask me that. But I said, as a follow-up to our conversation on the life/long-term care hybrid products, I wanted to provide you with some additional information. This product is interesting and how it works is compelling. Here are the highlights of the policy. It is built on a life insurance chassis, so we can lock your rates for the rest of your life based on your current age and health. It provides a tax-free death benefit to your heirs when you die. If you have a need for long-term care, nursing home, assisted living, in-home healthcare, or custodial care, you can begin accessing up to 4% of the death benefit per month to help offset those expenses. A $100,000 policy would give you access to $4,000 a month. A $200,000 policy would give you access to $8,000 a month. This is a rider that is outlined on page 8 of the attached document. And then I highlighted the verbiage there. It's the accelerated death benefit for chronic illness agreement allows you to access a portion of your policy's death benefit for chronic illness benefits. Upon the insured being certified as chronically ill individual, you may receive monthly benefits to help with expenses. Monthly benefits may be used for any purpose. Number four, the money is paid directly to you so you can use it as you see fit. When you think about more traditional types of long-term care insurance, oftentimes that benefit has to be paid to a skilled caregiver. So either a licensed nurse or a licensed home health care company or a nursing home. It has to be paid to them. With these hybrid products, that money can actually be paid to the member or the insured member. And that's really nice because that member can then use that money however they see fit. Maybe they want to pay somebody who's not actually a skilled caregiver to come in and help them. Maybe they just want a friend or a family member or a neighbor to come in and help them, and they want to pay them for that. With this type of a product, because the benefit comes to the consumer, they can actually do that. Number five, you never lose in this policy as long as the premiums are paid. You're either going to burn up the benefits on long-term care expenses before you die, or you're going to leave a tax-free death benefit for your heirs. And number six, you can fund this policy in a lot of different ways, from a monthly premium to a single one-time dump in of cash. There's a lot of flexibility in how and when the premiums are actually paid. It's important to know that you have to be healthy to be able to get this kind of product. Way too many folks wait too long until they're sick to start thinking about this. And then I said, check out this article and the stats around long-term care. Per this article, 70% is the percentage of people turning age 65 who will need some type of long-term care service in their lifetimes. So if you're turning 65, there's a 70% chance you're going to have an expense related to long-term care. So what are we going to do with that? There are a lot of ways to fund this, from paying monthly or annual premium for the rest of your life to investing a one-time single lump sum premium. If you'd if you'd let me know if you'd like to schedule another time to chat about the costs and how this plan might help you. That's just kind of a high-level overview that I use to like draw people in a little bit and maybe summarize the conversation that I've actually had with them. One other thing that I just want to mention here before we move into product and design. When you look at this type of a product, to and this would be the same across most types of long-term care insurance. To access the long-term care benefit, you have to have a trigger event. And typically, the trigger events are one of two things. And this is pretty typical across the board. I won't say every product because I don't know every single product, but most products work this way. That you either have to be unable to do two of the six ADLs, activities of daily living. So you think about that. They identify six different things that are activities of daily living. So feeding yourself, getting out of bed, like transferring from a bed to a chair, bathing yourself, wiping your butt, dressing yourself, and I think there's one more. There's like six things that are defined as activities of daily living or ADLs. And if you are unable to do two of the six as certified by a physician, then that triggers the policy for benefits. The second trigger event would be a cognitive impairment. So typically that's going to be dementia or Alzheimer's, and it would be a diagnosis of that that would trigger it. So usually you've got to have one of those two triggers before someone can start accessing whatever long-term care benefits might be a part of the product that they actually purchased. So before I move into product in a little more detail, are there questions at all around anything that we've talked about to this point? Sandra, is anything in the chat box? No? Okay. All right. So what I'm going to do next is I'm going to share my screen here. I think I'm going to share my screen. I'm going to try to share my screen. And just to kind of let you guys know how I would get to quoting the products we're going to talk about. First of all, I'm on the main page of the Resource Center. So I'd click on the carriers page. And then I would select whatever state I'm working in. I'm going to select Indiana. And then it'll bring up all of the different product lines over here. I'm going to click on life insurance, and then I'm going to come down to the Securian Minnesota Life product. Um, on the Securian Minnesota Life carrier page, I will then come under carrier links, and right here is the Securian agent site. We call it the Life Center. This is actually a website that Securian Minnesota Life built out specifically for health markets agents, and you can actually log in through. The only way you can log into it is through that portal. I will mention that right now, sub agents don't seem to have access to that, to this Life Center. We are working through that to get sub agents access. So if you're a sub agent and you want to quote this product, you probably need to work with your sponsor agent to get into their Life Center or work with them to get that quote. So this is the Securian Financial Life Center. This is where we can quote and enroll members directly with the carrier, and a variety of ways you can actually go through this. Where I'm going to go to kind of talk through some of the products that we're going to discuss. First of all, I'm going to go to products here, and I'm going to look at the life insurance LTC hybrid products. So these are some of the products that Steve is actually going to be going over here. Specifically the secure care products. This is a little bit higher level type of product. I will point out here that when you come into the Life Center, both Dave Schroyer and Scott Gauger are our two representatives. And so if you're working through a case or trying to build an illustration or you're trying to accomplish something with a life insurance product that you don't know how to accomplish, I would call these guys. Dave Schroyer is probably a little bit better, like, because he's internal. He sits at his desk all day and takes calls from agents and helps them through cases. Scott Gauger is more of a regional vice president. Good dude. He comes in and speaks to our team semi-regularly. But I just wanted to make you aware that those were actually there. So that's one product. The other product that I'm going to look at today is the indexed product. So the indexed products have a couple of different versions and ways that they're built. One is what's called the Eclipse Accumulator. This would be a product that is more focused on cash accumulation inside of the policy. The one that I'm going to focus on though is the Eclipse Protector 2 IUL. This is the product that I'm probably the simplest product available um, when it comes to these hybrid products. So I'm going to go back to the main screen and I'm going to click on Life Illustrations here. This These products that we're talking about today are not in Quote Connect. You actually have to go directly to the carrier and quote them because they are more complex types of permanent life insurance products. So I'm going to come in here and I'm going to say, first of all, I live in the state of Indiana. And I'm going to come in and I'm going to look at the Eclipse Protector. This is the product that I want to use for this. Now, a couple of things I just want to mention with this. With this Eclipse Protector product, I'm going to build this illustration and this policy for two things. Number one, to have a guaranteed death benefit until they die. And number two, to give us access to that death benefit in the event that we have a long-term care need and be able to pull up to 4% per month from it. I am typically selling this product to somebody in their 50s or 60s or maybe 70s. And so I am not building this permanent product to have cash accumulation or to have a cash value. That is not the purpose of this particular product. So I'm going to click on insured here. Now that I've got the state, we're going to be Mr. John Doe. And we're going to say John Doe is going to be 62 years old, male, preferred non-tobacco. Now you have various tobacco or various types of ratings here. I'm typically quoting preferred non-tobacco, which is not the best. I never quote the best. I'm usually, if they're really squeaky clean, height and weights are good, very limited medications, I might go preferred non-tobacco. A lot of times I'm quoting the standard non-tobacco though. I'll start there. If they've got any health issues at all, I'll start with the standard non-tobacco. So leave this gentleman at preferred. I'm not going to put in any extra cash. I'm not going to mess with a lot of the rest of this. I'm just going to go to design. Now on this design tab, I typically, when I'm quoting this product, I start out with a $100,000 product. 100,000 is the minimum that you can actually sell, the minimum benefit level. And so that's kind of how I build this out. I'm also going to yeah, I'm going to leave that there. I'm going to leave that the way that it is. I'm going to leave my death benefit at level and then total annual premium. This is the one place I'm going to change something, and I'm going to change this to no lapse guarantee. What this is doing is when I change the premium to be defined as no lapse guarantee, I'm basically asking the system to tell me how much premium needs to be paid in so that we guarantee that the policy will never lapse, regardless of what the internal cash value might be. Many of these permanent policies, they kind of collapse when the cash value gets to zero. But with this particular policy, I am putting this no lapse guarantee on it so that even if that cash value goes to zero at some point in the future, the death benefit remains both to pay out if the person dies or to tap into to pay for long-term care expenses if needed. So that's why I'm setting that up that way. I usually quote it annual. It's a little different pricing. You get a little better price break at annual. So I usually quote that as annual. If I click through to the next screen, which is distributions, I'm not going to put any distributions on this. And then on the rider tab, this is where I'm going to start to do a little bit of work because I do want to add this accelerated benefit for chronic illness agreement. If I want to know more about it, this is the information that I actually uh, copied and pasted into my email. But I'm going to add this. I want that to go away. There we go. I'm going to add this. I'm going to say the amount is the same as the base, and I'm going to jump this up to 4%. You can choose 2% or 4%. That's how much monthly you can pull out of the death benefit to pay for long-term care expenses. The only other thing that I'm going to do here is I'm going to make sure that this no lapse guarantee agreement is checked yes. It is because 2 screens ago I notated that. But again, this no lapse guarantee agreement provides that the policy will remain in force even if there's no cash value to cover the monthly charges. The no lapse guarantee agreement will affect future cash value available only at issue, and it can't be placed on a policy, other types of policies. So that's really the only, I'm going to add this rider to it, the accelerated death benefit for terminal illness, and then I'm going to add this no lapse guarantee. Assumptions, many of these policies allow us to put money in different indexes. I'm just going to leave this where it is because I'm not even concerned about anything to do with the cash value. And then at this point, I can click on Run Case. What this is going to do now is it's going to produce an illustration for me that I can actually download. So this is a high level overview of it right here. A couple of things I'll point out on this. First of all, so this is a 62-year-old, $100,000 policy. You can see that it's about $2,400 per year in premium, which is about $200 a month. And that gives him a guaranteed death benefit of $100,000 and the ability to tap into it. And that no lapse guarantee is active. And that becomes a big deal later in life because what you can see is that these cash values inside of the policy are going to grow. But by the time the gentleman hits 87 years old, 26 years in, that cash value is going to go to zero. Now, for most permanent life insurance policies, if that cash value went to zero, that is not good because the policy would lapse. In this situation, you can see because I've got that no lapse guarantee on it out here, that $100,000 policy remains, even though there's no cash value inside of it. And they continue to make the premium payments until they pass away. If they make it to 120 years old, they win, they get the 100 grand. That's kind of how that works. So I am going to click on view presentation here. And this is downloading. I think I glanced away for a moment. So here we go. And this is a very nice brochure, or like, yeah, it's almost like a brochure, but it's an illustration that you can use to walk your clients through it. The nice thing about this, I can download it and save it if I want, but the client's information, who I am, my contact information, the date and everything is on the front page here. As I go down through it, I can see this is a John Doe, male 62, preferred non-tobacco, death benefit 100,000, annual premium. This is a little bit more details on how that works. You can see here that this asterisk is out here, which notates down at the bottom. Actually, clear down at the bottom. That notates that the no lapse guarantee is in effect right here. So this is the actual illustration then. So it's not a very complex illustration. There's not a lot going on here. They're paying $2,400 a year to have a $100,000 death benefit that they can tap into to the tune of 4 grand per month to pay for long-term care. This particular product is a great, more entry-level type of product. This is a product that can be paid forever. I mean, they can start making premium payments on it today and pay it until they die. That's going to be the cheapest way from a monthly and annual premium perspective for the client to pay for this. Now, there's other ways they can do this. They could say, I want to pay into this for 10 years and then never pay another premium payment. And we could back into what premium they need to pay each month or each year for the first 10 years. I had a case a couple of years ago. A gal called me. She said, I want a $200,000 policy. She said, I'm going to work for another 5 years. I have $50,000 cash sitting in my savings account. So what I'd like to do is I'd like to put in $50,000. I'd like to make 5 annual premium payments for the next 5 years because I'm planning to work for 5 years. And then I want that have that policy paid up. How much money would I need to pay in each of those 5 years to do that? So I worked with Dave Schroyer at Minnesota Life, and we backed into the math. And basically, what she did is she put $50,000 in up front, and then she made five equal $8,000 annual premium payments. So she put in another $40,000 over the next 5 years for a total of 90,000 that she put into the policy. And now she's guaranteed for the rest of her life. Once those premiums are paid, she has a $200,000 policy locked in for the rest of her life. When she dies, it'll pay 200 grand minus anything that she's taken out of it. And because it's a $200,000 policy, she can pull 4% per month, which is $8,000 a month that she can pull out of it to pay for long-term care needs. So that was a very unique way of funding one of these policies. So it doesn't have to be done monthly or annually, although that's where you're going to get the cheapest price point. Or you could do it a variety of other ways. I had a husband and wife a couple of years ago, farm family. They wanted a $200,000 policy on each of them, and we kind of backed into the math. They each plugged in $100,000 one time into a policy for themselves and created about a 200. It wasn't exact, but it was about a $200,000 policy for each of them. So they just one time dump in of 100,000 each, and then they were paid up forever, guaranteed. So there's a lot of cool things that you can do with this type of a policy, and this would be, I think, more of an entry level type of hybrid product. Um, I would say the reason it's entry level is because it is fairly simple. It is fairly linear. There are two things about this though to understand. Number one, it's one bucket of money. So in this scenario, on this policy, it's one bucket of $100,000. It's either going to get burned up paying for long-term care, or the remaining balance will be paid as a tax or a tax-free death benefit. So it's one bucket of money that we're working off of with this. The other thing to consider with this type of a policy is that there's no inflationary component to it. So that $100,000 bucket of money that they're buying today is not going to grow over the next 10, 15, 20, 30 years. So the cost of care 25 years from now may be much different than what it is today. They would continue to have this exact same benefit for the life of the policy. So that's why I say it's more of an entry level type of a product. Um, the other big thing before I pivot over to Steve that I would say about this policy is that a lot of people coming into these types of policies will say things like, well, with this policy, I've only got the access to $4,000 per month to pay for my expenses. A nursing home would cost me 8 or 9,000. Okay, my response to that would be if you've got to come up with 8 or 9,000 dollars and this policy is going to pay half of it, you only have to come up with 4 or 5,000 dollars. Then it's going to slow down the bleed on your assets and your resources. It will be helpful. So just because it can't cover 100% or it's not going to cover 100% of whatever your bill might be, doesn't mean there's value in it. Something is better than nothing. The whole idea of buying insurance is taking some of the risk that's on your shoulders and shifting it to someone else. Very few people can afford to shift 100% of the risk. It's just too expensive to do. So most times we're left with some amount of risk in ourselves, right? And that's kind of how I would think about, buying something than, full protection or something less than a policy that would pay 100% of what the potential risk or cost, might actually be. So this is the Eclipse Protector product that's in the portfolio, the Eclipse Protector 2. Hopefully, I've given you a little bit of an idea of how it works. I've given you a little bit of an idea of how to quote it and build illustrations. It's a pretty simple product. Once you've built one or two or three of these, you kind of get the sense for how it actually works. Um, I'm going to pause for a moment and see if there's any questions, and then Cav, we're coming over to you.
I got a question. Does if they start paying right away, let's say they pay into it for a year and something happens to them, they can start getting the benefit, or if they die, they get the full benefit, even there's no minimum amount of time.
That's correct. I mean, the second month, if they passed away or went on claim with, needed long-term care, it could put, I mean, it would pay at that point. So that is a huge benefit of these policies. That's 100% right. I'd also say one other thing to understand is most long-term care policies, and these policies are built this way too, that they have a 90-day elimination period. So what that means is once the policy is triggered, once you can't do two of the six activities of daily living, there's a 90-day window before the policy starts paying. So it's kind of almost like a deductible of sorts, where the consumer will have to pay the expenses for the first 90 days. Then the policy would start kicking in and paying on a monthly basis.
Wait, for this product or for traditional long-term care products?
Both. Now, traditional long-term care products, you can pick that elimination period. You can go from 0 to 365 days usually, but 90 days is the most commonly sold traditional long-term care policy. And then on the hybrid products, they also have that 90-day window. You can't pick what the window is. It's 90 days on these securing products.
And think about it this way, especially if somebody has Medicare, because um, if somebody's in a facility and they're there, technically initially as a rehab stay, they have actually up to 100 days for Medicare. But then remember, after day 100, Medicare no longer consider their stay as rehab, so it's really custodial care.
Other questions?
There are some questions in the chat, Silas.
Okay.
And I'm sorry, I didn't catch this earlier. Kendra asked if you initiate the 4% for long-term care needs, is that also tax-free? I think she might be referring to the inflation rider. I'm not sure. I'm not sure what that was.
There's not an inflation rider on here.
Okay.
On this particular product, there's no inflation rider. So the benefit coming out of a policy like this is not taxable income.
because you're paying for it with tax dollars.
Right.
Right.
The
You can't
premium
write
you're
off
paying
the
is already
premium.
been taxed, so the benefit coming out would not be taxable income. The other thing to just mention is once you go on claim, once you start receiving benefits, you stop paying premiums too.
Mm-hmm. Maddie asked, what is the minimum initial premium versus annual?
So with Minnesota Life, they require that you pay more than the first. It's like 2.5 months worth of premium upfront, bare minimum, just to make sure they've got enough to get the policy in force and it doesn't lapse like immediately. So there's an initial premium that has to be paid just to put it in force. If you're paying it annually, though, the annual premium is should always be more than the minimum acceptable premium. It'd just be you'd run into that if somebody was paying it monthly, they might have to pay 2 or 2.5 months up front. They tell you how much needs to be paid up front to get the policy going. So that would be what that is. That one's in the
And
weeds a little bit. It made me dig for that one.
yeah. Maggie asked, why would the cash be gone when he turns 85 if he hasn't taken any cash out yet?
Because the way these permanent life insurance policies work is that you're locked in at $2,400 a year. But you got to remember the cost of insurance is going up every single year as you age and get older. So that cash value in the early years, your cost of insurance is low and there's cash going in. But eventually the cost of insurance is going to rise and it's going to eat up all that cash value internally. So that's all happening internally because the cost of insurance is going up every year as you get older.
That's it for the chat.
Perfect. So the second product that they have in their portfolio is what's called the Secure Care. And Steve has done some studying on this. There's a great video that he watched out there. I've sold a couple of these now as well. These products are a little bit more robust of a solution, typically for higher income, higher net worth individuals that maybe have the ability to pay higher premiums for a shorter period of time and punch some money into it. The nice thing about the Secure Care product is instead of it being one bucket, they divide it up into two buckets and they diminish the amount of life insurance bucket so that they can enhance the long-term care bucket. So you still have a very small life insurance policy with this. Typically, it's about equal to what you've paid in premiums. So you kind of, if you die, you're going to get your money back, but you're not going to make anybody rich off of that. But that then gives them the ability to really beef up the long-term care benefit and to put inflationary riders or the option for inflationary riders on that long-term care bucket so that over time that bucket can grow so that when you use it in 30 years, it's a much larger amount. So this is just a different type of product design. But with that information, Cav, I'm going to turn it over to you. I'm going to give up control so you can share the screen and you're welcome to run with the Secure Care now.
All right. Well, and one thing I want to mention, the product that Silas went over, you do not need to be long-term care certified, but with this Secure Care, you do need to, which that entails there's like an 8-hour course that you have to do initially, and then you have to do 5 hours every 2 years. But you do need to be long-term care certified for this. So First thing I want to show you is when you come into Securian, if you go to the Secure Care 3 library, which next week's going to be going away because Indiana's going to have the Secure Care 4, which Michigan does right now. But when you go in there, there's some videos you can watch. How to present a long-term care solution. There's tax planning. But the one that I watched is called Minimally Funded Maximized Protection. And so I watched that. It's like a 5-6 minute video on how they recommend we should build it. Okay. So with that being said, so what you want to do is you want to come over to illustrations. The product, I'm going to do this, since we're going to have this in Indiana next week, I'm going to do the Secure Care 4, and I'm just going to put in Michigan. And the nice thing about this issue state is if you can't sell it, as you can see, Indiana's not showing up here yet. It will next week. Now for the insured, I'll just put this in for my wife's age, because like I said, the sweet spot for this is starting at age 50. And then the only thing you can do here is you can do non-tobacco standard, or if you're doing a husband and wife, you can do a couple's discount. But then when you want to design it, you want to come in here and you want to do the single premium for as long as you can. So with the Secure Care 3 was 15 years. This is actually 20 years. I actually put it in the monthly ETF because people understand monthly better. And then when you come to this, all you want to do is put specify face amount. It's going to default to the 50,000. That's what you want, the 50,000. You want to leave this at 85. You want to leave this, and then you want to put in a 3% compound. That's it. So really, you're just putting in the premium, specify face amount, 3% compound. And Silas, the thing you did, what was that, a couple $100 a month?
2,400 a year, so 200 a month
Okay.
for $100,000 benefit.
Yeah.
And the most they could ever pull out of it was the $4,000 per month. I mean,
Right.
the 4%. So that would be the maximum today or maximum down the road.
All right, so view presentation. And again, the nice thing about these bigger life cases is you need to present using the illustration. It just makes it so simple. Don't use Quote Connect for life insurance unless it's like the United Healthcare. Everything else should be
term and final expense you can do in Quote Connect.
Yeah.
Yeah.
So again, you got the proposal.
Could you zoom in just a little bit, Cav? I know there's some old eyes on the call.
Is that better?
I wasn't talking about you, Sandra.
So here's the deal where the premium's going to be $229 for 20 years. Okay. But the only page you really need to show is this right here. So basically what it's showing is, in this particular case, they're going to pay $55,000 in premium for 20 years. Now, if they die at any point, they're guaranteed $50,000, whether it's year 2. And that's the thing I think about is like, well, I'm going to pay more into this. Well, in 20 years, someone's in their 70s, you're not paying that much more into it. But look what it does for the long-term care. So starting day 1, they've got $161,000 for long-term care day 1. But by age 85, they have $428,000. Much bigger bucket of money for about the same price as the other one. Okay. So then when you actually look at the illustration on this, so the first year, they're going to pay $2,700 in premium, $50,000 death benefit, but there's that 161. So very first year, they have $2,000 that they can use for long-term care. But as they continue to pay the premium, it starts going up. But then once you hit 72, you're no longer paying premium. But now death benefits going up, their long-term care that they're entitled to is going up. And it just continues to grow. So the longer they live, the more they're going to have access to. So the one that Silas showed is going to have more money for long-term care initially. This one's going to have more money long-term, and you don't have to pay for it your whole life. So
And I
that's
think kind of asking the question, like, what do you need too? If they have a need for permanent life insurance and long-term care insurance together, maybe the
Mhm.
first product is a little better because you can get a large, I mean, for the amount of money, you can get a larger death benefit, right? If they're like, I don't really have a need for life insurance, I've got a bunch of life insurance elsewhere, I'm really more concerned about having a larger long-term care benefit later in life than the
Mhm.
secure care because you can see they're diminishing the life insurance bucket to enhance the long-term care bucket. And it's two separate buckets in this particular product, not one like the Eclipse Protector 2.
Yeah, I mean, and this is something that you could do for someone in their 40s. Say, hey, pay on this for 20 years. By the time you're 60, it's paid off, but it's going to continue to earn interest.
Right. It'll
So this
continue to
is,
grow internally, which is really sweet.
yeah. So if you've got that person who is thinking about, having a little bit of permanent insurance, instead of just doing like an IUL or something, you may show them this because again, one of the reasons why this is so important is, Silas was right. 70% of people over 65 will need long-term care, but the average person will spend about $138,000 on long-term care in their lifetime. And so again, having products like this, and then we have other ones that if this doesn't work, we have a thing called recovery care, like Silas mentioned, that you can build that. But the bottom line is we need to have this conversation with people because when people hit 65, the biggest threat to their income is not medical bills. It's not being able to move or think. And so if you've got a 70% chance of needing it and the average out of pocket's 138,000, I literally just ask people, what kind of plan do you have in place for that? And they're like, nothing. Are you comfortable with that? And then just show them some options. But I mean, this is something that we should start talking to people about earlier. And the reason why is your age and health matter to get it, like Silas said. But an accident or an illness can strike at any age. If you get cancer, you're in a bad accident. And this right here says 41% of the people that need long-term care are under the age of 65. I would almost think that I wish we would change our P4L to have a four-component solution to reduce medical bankruptcy. Medical insurance, supplement, life, and long-term care. It's really those four things that we should be focusing on are the four areas that we need to make sure people are protected or at least talk about. They can always tell us no.
Right.
But if we're not letting them know they're exposed, and guys, the easiest way to do that, I'm kind of going on a tangent, Tyler, Silas, is that okay?
Sure.
But the easiest way to do this is right here.
You're so organized, Cav.
It's a problem. Um, is this financial snapshot. One of the questions on
Can you
there
zoom in
is
again?
provide, huh? What's
Can you
that?
zoom in? We hit zoom in.
Yeah. So
Thanks.
again, this one right here. Once we get their need for life insurance, we can start using this financial snapshot to start finding some of the bigger life cases down the road. And one of the questions is providing long-term care funds, such as nursing home for myself or my parents. And that's usually the question I'll ask people is, again, you got a 70% chance of needing long-term care. The average cost is 138,000. Medicare and health insurance isn't going to cover that. What kind of plan do you have in place? I don't. Well, let me go do some shopping. Let's look at some options. So it's a great way to set up for like policy reviews or future appointments once we take care of. So it's almost like a stair step. Health insurance and subs first, life insurance second, long-term care fourth.
And I would say if they're younger than 55-ish, you might replace that long-term care with
With this
disability
down here,
insurance.
disability right here. Yeah, exactly.
So I think disability insurance is kind of that fourth piece under 50 or 55,
I would
over
say 50.
55, it's long-term care, right?
Yeah. Yeah. So again, guys, if we will just start kind of learning these four product areas, those are probably the only four areas we really need to learn to really help our customers. I mean, there's other things out there like IULs for retirement and key man insurance. Those are the big elephants that you get. But man, for the everyday stuff, to be able to focus on health, subs, life insurance, and then some sort of long-term care product, that's how we help our customers over. But you're not going to do it all in one appointment. This is about building that relationship. And maybe you don't worry about long-term care the first year, but you get it next year.
And I think you start having the conversations and keep bringing it up. That's where I've gotten some of my biggest cases. I've sold some of the biggest life insurance cases in our territory, and most of them were hybrid products like this. It wasn't they weren't buying it just for the life insurance, they were buying it for the hybrid component of it. And you start thinking about it. I mean, people ask me, "Oh, how much does this cost?" It's really expensive, right? Well, I think about, the product that I built out, that first one, that was a $100,000 policy. You could buy $500,000 of that product if you wanted, and a half a million would be 5 times what I paid, so it could be $12,000 a year in premium. That would be like the high end, $12,000 a year. On the low end, I can build an Aetna recovery care product that only covers home health care for less than $100 a month for most people. So you've got long-term care options between less than $100 a month per person up to 12,000 plus per year per person. So anywhere from less than 100 to 1,000 a month that you can build things in. So one of the things that I've had a few clients do is I've said, I know this seems overwhelming. Why don't we approach it from this angle? Why don't you guys go talk about what kind of a budget you have for this, and then come back to me with a number, and I can tell you what you can get for that number. So I think that's really a great way to do it. Maybe it takes some time to explain all of this, but when people feel overwhelmed, I'm like, I don't care how good the insurance is if you can't afford it. This really boils down to what can you afford. So go talk about it, come back to me. Anything over 70 or 80 bucks a month, I can find a solution for you and tell you what you can get for that amount, and then back into some of these products. So that's another good way, I think, to approach it with clients.
Well, and the other thing too is just showing something like this, 80% of all long-term care is provided in the home. So when we sit there and think of, well, that 4,000 isn't enough, or that, well, if most of my stuff's home health care, which is about 3 to 4,000 a month, that's going to be plenty. See, when we think long-term care, we think old people nursing home. Most of the people that are doing it is they buy these products so they don't have to go to a nursing home. They can pay someone to take care of them in their own home. And that's kind of an angle that you want to kind of get with these people, is like, hey, because if you have to go to a nursing home and you can't live at home anymore, well, you're going to spend down your assets, and Medicaid's going to take over. But if you want to put in a wall of protection to where you can stay in your home as long as possible, that's what these products are for. I never talk about nursing home. I always talk about, let's keep you out of a nursing home. And that seems to, again, get people emotionally involved. And this was a presentation from John Hancock that I got years ago that kind of explains all this stuff. Talks about how Medicare doesn't cover all this stuff. And then there's this thing called caregiver health, because you're going to hear this too well, my spouse will take care of me. So what I like to do is say, okay, John, go lay on the floor. Mary, go pick him up 10 times. I can't. Okay, you need this then. It's just little things like that that gets people thinking, because they don't want to deal with this until they absolutely have to, and then it's too late. Our job is to let them know they are exposed, let them cover the exposure. But our job is just to tell them. We can't make them do anything.
So Maggie asked, first of all, Alan asked about, is there an advantage to taking 401k money and paying upfront premiums with either one of these? There may be. I would tell a client, I don't know enough about your financial situation to advise you on that. You should talk to your financial planner and see, because to Sandra's point there would be tax consequences of pulling money out of a 401k. And I don't know if the upsides of the benefits you get from the policy are going to be worth the penalties you'd be paying to get access to that money prematurely, right? So that wouldn't be like a strategy I would say, oh, this is a no-brainer for everybody. Might it work for some? Possibly. Maggie says, does this policy pay the client money each month for long-term care, or do they pay the in-home health company or the nursing home? So, like we mentioned earlier, this is an indemnity policy, Maggie, that pays the consumer directly. So the money comes to consumer and then they divvy it out however they want, which eliminates the need for their caregiver to have to be a skilled caregiver. It could be somebody, a friend or a family member that's just coming in to help them, which I think is really beneficial. Do the in-home healthcare have to be certified company? Okay, so it can be a family or friend when it's being paid to the consumer, like with these hybrid products we were talking about. What about HSA money? Can we use those to pay for these? That's a great question, Stacy. So, my understanding is that HSA, accumulated HSA money that you've accumulated before age 65 can be used to purchase a traditional long-term care insurance policy, but I don't think the hybrids it can because they're technically a life insurance policy that is acting like a long-term care policy. So I think it's just the traditional policies is my understanding that can be paid with
But
accumulated.
as the traditional long-term care policies go away and these become more prevalent, I could see a change.
Yeah, I absolutely could too. The last thing I'll leave you with is a lot of clients say, well, who needs long-term care insurance coverage? I'm like, honestly, when I think about it, I think it's people who have between 250,000 in net worth, 3.5 to 4 million in net worth, and they don't want to burn up all their money laying in a nursing home or at that last stage of life. And the reason I picked those numbers is because if somebody comes to me and says, "Oh, I need long-term care insurance," I'm like, what are you trying to protect? Well, I've got $100,000 of net worth. I'm like, it's not worth paying an insurance company 2, 3 grand a year in premium to protect 100 grand, my opinion. Like, I just don't think that's a good number. I think that if somebody has over 3.5 to 4 million, they can probably self-insure the long-term care expense and pay for it out of their own resources and have plenty left over to do whatever else they want to do with their money at the end of their life, right? So a lot of this conversation, so I tell people if you got between 250 to 300, or I'm sorry, 200 to 250,000 and 3.5 to 4 million, it's people in that range that should be considering long-term care insurance if they don't want to burn up all their assets at the end of their life. Um, I would also say that these people who have coverage to pay for these expenses are going to have far more flexibility. I mean, if someone's game plan is to rely on Medicaid to cover them at the end of their life, there's not a lot of control when you're in Medicaid. I think they have to put you within a bed in a home within 70 miles of your home zip code. I read that somewhere. So husband and wife, one could be in LaPorte, Indiana, one could be in LaGrange, Indiana, technically later in life. And obviously, Medicaid facilities aren't always the nicest smelling facilities. So, which is
When
important.
you walk into these facilities and you go in the private pay wing versus the Medicaid wing, there is a little difference.
Yep. So
This
having
is
control later in
talking
life is
from
one of the,
experience with my father-in-law.
yeah. But a lot of people do want more control later in life. Again, I go back to, I don't push people to buy long-term care insurance. What I am going to push you, and I'll say this, what I am going to push you to do is think about it, talk about it. Let's have a conversation about it while you still have a choice to make. Because eventually the choice is no longer going to be yours on whether or not you can get it. The answer is just no, you can't. And I've had too many of those conversations. Those are usually Honestly, those are the more common conversations where somebody's coming in and if somebody's coming to you and asking about long-term care insurance, probably a good chance there's writing on the wall and they can't get it, right? Their wife's having trouble losing her keys all the time, or one of them can't drive anymore, or like things are happening that they understand the need and they're a motivated buyer. Once someone's a motivated buyer for long-term care insurance, they're probably not eligible for it, is the unfortunate reality. So it's our job as insurance agents to be the what if guy. And I tell my clients that too. It's my job to think for you about what if this and what if that, and ask you what your plans are, and then hopefully help you build a plan around protecting yourself and your assets and your heirs. So last thought, when you position yourself like this and you start talking about some of these bigger, deeper products, this does position you more as an advisor and a trusted advisor than just slinging in, health insurance to them, right? Or enrolling them in a Medicare Advantage plan. This takes that relationship one step deeper. And many of these products have 60, 70, 80% commissions on them, first year commissions. So they are lucrative to sell. It's a little bit longer process. It does take a little bit more time and effort. and the underwriting can be kind of arduous to work your way through. But there is a financial upside to it as well for you. So, any other questions before we wrap up? I know we're 10 minutes over, so sorry.
Yeah, I just put one in the chat. But Steve, I noticed on this illustration on the Secure and Care that it says total LTC benefit period 6 years. Does that mean it'll only pay out for 6 years?
Correct.
Okay, I just wondered.
Yeah, and you can adjust it. I think the lowest is 4, the highest is 10, but they said the sweet spot is 6.
Got it. Okay.
I will say most traditional long-term care policies that are sold are a 3-year benefit.
Right. Yeah.
Yep. So, all right, friends. Well, I hope this was helpful. We have no idea what we're doing next week for ADT, but Cav and I will work on it. If you have any ideas of topics you'd like to see covered in the next couple of weeks, we'd be open to input. Not saying we can get to them all, but we would be open to input around that. We will be moving in a little bit into our summer speaker series. We're going to be doing some interviews and things. I'd encourage you continue to utilize the YouTube channel because there is a lot of great content out there from past presentations we've done and trainings. If you're in Indiana, just remember we do have an Indiana sales team meeting this Friday in Elkhart, so hopefully you can be there in person and not just virtually. We'll look forward to seeing you. We got some great content lined up for this Friday. Or for those of you in Michigan, I don't know your meeting schedule, so reach out to Tyler and or Gary and figure out when your next meeting might be. I hope you all have a great week though, and enjoy the warmer weather, and don't hesitate to reach out if there's anything we can do to support you. Thanks, guys. Appreciate y'all. See ya.